First of all, I would like to thank basically IABI for giving me the opportunity, and thank you Ernest and Young for providing the premises. The most importantly, I would like to thank Farida, who called me around 3 days back to remind me about this event. I had forgotten about that. I was in Bahrain. We are actually in the process of opening an office. We have just opened that, and we have actually got a mandate in Bahrain to convert a conventional bank into Islamic. So I was all focused on that when Farida called, which sort of slightly panicked me as well, because coming here basically for a presentation, it's not only presenting, basically speaking, you also need to provide some slides. Now, I arrived last night. I came to the office late, but I am quite thankful to Saud and Zahid, who I had an opportunity to discuss it, and within 2 to 3 hours, basically these slides were made. So thank you guys. On the other hand, if there is any content missing or there is any issue with the animation, it wasn't me. Yeah. So coming to the basically the liquidity in the Islamic financial markets, we are seeing new players coming onto the Islamic markets or trying to access liquidity from the Islamic markets. And this is something which have been sort of being discussed. If someone is considering to come into Islamic finance, or they are looking to raise money from the Islamic markets, what are the aspects they need to consider? Now, before I go into that particular aspect, just want to give a bit of a background. Middle East has been playing an extremely important role in development of Islamic finance. If you look from a pure financial perspective, the Islamic finance, what we see here, or currently being basically we are basically using that models, a framework. Islamic finance has been more demand-based rather than need-based, yeah? Because the conventional finance was always there to fulfill your needs. With the liquidity coming into the Middle East, especially in the last 15-20 years, and especially with the oil maintaining high prices, if the statistics are correct, what I remember based on what I last saw, the Middle East, especially GCC, which is the Gulf Cooperation Council, which consists of 6-7 countries, including Saudi, Bahrain, Qatar, Oman, United Arab Emirates, and Bahrain, basically they get around 4 to 6 billion US dollars every day. These are petrodollars. So they are selling petrol to Europe, to US, and they are getting a daily liquidity estimated to be 4 to 6 billion US dollars. And that is every day, which in a year roughly converts to between 1.5 to 2 trillion US dollars. Now these funds need to be invested. And over the passage of time, the investment criteria for those investors are becoming more and more Islamic. Hence, it is becoming important for all the conventional institutions who have businesses with the Middle East, or the organizations which have been relying on the liquidity being provided by the Middle Eastern investors, to consider Islamic finance. What happened during the current recession, the liquidity in Europe and US was significantly impacted. And to add further complications to that, basically we also introduced Basel III. Now Basel III created more complications in lending. If you are especially talking to an unrated institution, your cost of capital going high, you are basically implementing very strict single party limits. So that created additional complications for the existing borrowers to borrow from the conventional. So they had to diversify. Over the last 5 years, we have seen a lot of conventional players coming into Islamic, tapping into the Islamic liquidity, which includes governments, which includes financial institutions, which includes corporates. So this particular presentation is focused on the key aspects and the challenges or the considerations which a new entrant who is coming into Islamic finance need to consider, need to be aware of, and should make a decision based on those judgments rather than just deciding, no, I want to go Islamic. Now, we come to the evolution. Okay, why is basically the evolution important? It is not important from the perspective of Islamic finance. It is just to give you a snapshot. What has Islamic finance achieved over the last 30 years? So the model, what we see currently, was started in 1975-76 with Bahrain Islamic Bank and Dubai Islamic Bank starting in the Middle East. Initially, it was focused only on commercial banking and some syndications. From 1991 onwards, we saw asset management coming into the Islamic space. We saw private equity coming into the Islamic space. And it was really from 2000 onwards where we saw the Islamic capital markets came into existence. That is where people came to know the word sukuk. They heard basically for the first time. So basically this is basically where we are. And I would anticipate that this particular stage will continue for a bit. Okay. Now, just doing a quick recap on the Islamic finance, I'll be basically very quick on the prohibition side. Basically, we know we can't do riba, gharar, maisar. We can't do anything in regards to the haram activities. One important aspect what Islamic finance tries to promote is the risk and reward sharing. Now, the important thing to note is that Islamic finance is open to all. You may be getting the fundamentals or the basis of this type of finance from the faith of Islam, but it does not prohibit anyone to participate in Islamic finance in any way. From an approach perspective, Islamic finance is more transaction focused rather than counterparty focused, unless and until you are looking at an equity issuance. If you are looking at an equity issuance, yes, the company needs to be Sharia compliant. But if you are doing a transaction and that transaction itself is Islamic, the counterparties are not important. Yeah. One of the crude examples basically I can give is you can go to a bar and have an orange juice and pay for the orange juice. The bar may not be a Sharia compliant entity, but the transaction you had with the bar was perfectly Sharia compliant. And lastly, Islamic finance is perceived to be very restrictive, which is not the case. Islamic finance is principle based. It has got certain prohibitions. If you keep away from those prohibitions, you can do every other thing. Now, when we look at a transaction and we say basically we are trying to do an Islamic transaction, what are the key aspects which we need to focus on? Or you can say basically what are the aspects the Sharia scholars look at when they are reviewing a transaction? The first of all is the economic sense. The transaction need to make economic sense for all the counterparties. Second, what's the purpose? The purpose of the transaction should be Sharia compliant. For example, if you are trying to open a casino, it will be very difficult to find a Sharia compliant solution to that. Yeah. But if you are trying to do a Sharia compliant project, yeah, from a structuring perspective, it's very easy to do that. The third aspect is the Sharia compliance. That is where we come to the structure. So we have identified the economic sense, we have identified the purpose, then we develop the structure. The structure has to be Sharia compliant. Yeah. And lastly is the legal enforceability. So the legal documents which support the structure needs to be Sharia compliant and legally enforceable. So with all these four aspects, we get a Sharia compliant transaction. Now, if someone is looking to raise Islamic finance through debt instrument, yeah, not through equity, basically through debt instrument, what are the aspects they need to consider? Or I'll just put it the other way around. If someone comes to you and say, my client wants to raise Islamic funds, what are the immediate aspects you need to focus on? Yeah. First, who is the obligor? Is it a company? Is it a financial institution? Is it a sovereign? Is it rated? Who is it? What is the purpose? What will they use the funding for? How much funding are we looking to get? And what is the maturity? Based on the purpose, what is the underlying asset and the collateral? Now, the words in bracket and its jurisdiction, these are very important because there are certain jurisdictions which are new and upcoming jurisdictions which the investors may not want to take an exposure to. Okay, let's give an example. If an American company is trying to establish a project in a very unknown or a small African country, so the obligor may be based in US, it may be a decent sized company, it is requiring funding, but it is going to put a project somewhere in an unknown place in Africa or in a place where the Islamic investors have less reliability on the legal framework or they are not exposed to that as a jurisdiction. Yeah, that can be a challenge. So when you talk about the jurisdiction, it is important that where is the underlying asset, because if you enter into a transaction, say a ijara transaction or lease transaction, where Islamic investors come in and they buy the asset and you lease it to the company. If something goes wrong, that particular asset is in a particular jurisdiction. And if the laws of that jurisdiction are relatively new or not tried and tested, which may mean that it will add a gray area for the Islamic investors to identify that if the transaction goes wrong, how much time will it take for us to get hold of our underlying asset or the collateral, liquidate it, and get our money back. The presence in Islamic or conventional markets. So the obligor, have they raised funds? Are they known? Have they raised successfully, whether Islamic or conventional? Yeah. Because if they have got a presence, they have got a history, they have got a track record, and they have, basically the investors have got some sort of confidence on them that they have raised the funds before and they are paying the coupons on time, the transaction is going well, so there is a bit of a comfort basically around those type of things. Jurisdiction of existing investors, which means if they have existing lenders, which jurisdiction they are based in. Because if you are issuing another transaction with them and they have got heavy investors from one particular jurisdiction, you may want to consider going to that jurisdiction first, because their name is very well accepted in that. And lastly, the future plans. Now, a lot of the companies, they come in and they say, yes, we want to raise 200 million now, and they don't tell us anything. Those clients need to be very open to say, I have got plans to raise 200 million now, and next year I am going to raise another 200 million. because their plans have a significant effect on the sales strategy. Okay? For example, if we know 200 million they are going to be raising now, and 200 million they are going to be raising next year, our sales team need to know that. What we will do is we will sell the existing note or the existing issuance for more than 200 million. We will probably create a demand for 300 million or 350 million. And after creating that demand, we will give them only 200 million. So we know that we have already got a demand of 100 or 150 million with these investors. Excuse me.
Have a good drink. Not impressed with that.
I got basically flew from Bahrain.
And the aeroplane.
Oh, thank you. No. So hence, it is extremely important to discuss with your client what are their requirements, both not only immediate, but probably 1, 2, or 3 years. No. Now, let's talk about the considerations from a client side. What are the aspects the client need to consider before deciding that they will be going into Islamic finance? These considerations, basically based on how I have seen it work, we have distributed it in 3 phases. Phase 1, phase 2, and this is phase 3. Okay, and we'll talk about basically these phases. Now, when you talk about understanding the local framework, this local framework applies to 2 things. Excuse me. It applies to where the company is based, where it is incorporated, and the other aspect is where the asset is based. And if you are giving a collateral, which is in a third jurisdiction where the collateral is based. Yeah. We will have to consider all these 3 regulatory requirements. And while you are considering these regulatory requirements, you have to consider potential tax as well. Because if the transaction is happening in a company in one jurisdiction, the asset in another jurisdiction, and an additional collateral, if any, in a third jurisdiction, you are exposing yourself to regulatory and tax considerations of all these 3 jurisdictions. So these needs to be carefully assessed. Then there are certain type of structures which are very well accepted in particular jurisdiction. We're not talking about Islamic or conventional, but if there are certain jurisdictions which have got particular structures getting certain tax advantages, they need to be considered. Now, coming on to the phase 2, which is developing the structure. One of the important aspects is identification of the Sharia advisor. Who are you going to appoint? What is their experience? What have they done in a similar type of structures before, or in similar jurisdictions before? Because Sharia advisor becomes a very key member of the team, which will eventually be resulting in a successful completed project. The second aspect which you need to consider is your target markets. Yeah, I'll come to the Sharia scholars after that. The target market is when you are identifying that I want to go into Middle East. Okay, when you say you want to go into Middle East, then which particular areas in Middle East, or you want to go into Far East? Because the Sharia board which you have to choose, who is going to approve the fatwa, they need to be acceptable in those jurisdictions. Okay. For example, if you are trying to sell a transaction in Saudi Arabia and you have got fatwa approved by scholars which are either non-GCC or not from the Saudi, or people have not heard of them, you will not be very successful. So you need to identify the target markets, and based on that you need to identify Sharia scholars who will support structuring and approving fatwa as part of this transaction. Now, the third aspect is the structure. The structure and the credit enhancements. When it comes to the structure, when you are doing the structuring, the regulatory aspects needs to be considered again at the structuring phase. If there is any advantages or any benefits we can take. I will come to the credit enhancements later. On the structuring side, for example, there are certain jurisdictions which facilitate murabaha. But if you try to do a transaction under ijara, it becomes heavily taxed. So these are the considerations you need to be keeping in mind while you are developing the underlying structure. Appointment of legal advisors. That is very important. The legal advisors you appoint for the transaction should not only have an international acceptability, but depending upon the jurisdictions you are touching. Let's take an example of a transaction. Let's assume that we do a Saudi transaction. The Saudi transaction, a real estate transaction, where they create an SPV and they transfer the usufruct of that asset to the SPV, and SPV is, let's assume, is in Caymans. For that particular transaction, we are touching two jurisdictions. When I say two jurisdictions, what I mean is most of the Islamic finance documents will be under English law. However, certain aspects of the transaction will relate to the asset which is based in Saudi and will be using the Saudi law. So you will be needing a law firm in Saudi Arabia to provide you legal opinion on the Saudi law, and an international law firm providing you an opinion on the English law. So when you appoint legal advisors, you have to consider whether you can appoint a law firm which have got a representative offices in the jurisdictions you are touching, or they have got associations through which they can operate basically for the purposes of that structure. The disclosure in the legal documents. Now, when you look at Islamic documents, they tend to be very different as compared to a conventional bond, for example. If you just take a difference of basically take legal documents of a bond and a sukuk, yeah, the bond, it does not need to say the purpose. It does not need to say how they are going to use the money, what is that money is going to be used for. In Islamic finance documents, these aspects are very well disclosed. So they are disclosed and they are sort of committed to the end investor. So the client, the obligor, should know upfront that whatever they are telling their advisors, they are committing with that investor, and eventually, basically in the next slide we'll see, there is an ongoing Sharia monitoring. Someone independent will come in and verify that they have been doing what they committed to do. The last but most important aspect is the pre-marketing. Now, once you have got a structure and before you have finalized it, it is extremely important that you approach a handful of potential investors and discuss the transaction on a no-names basis. You discuss the jurisdiction, you discuss the structure, you discuss basically the key aspects of the transaction, and ask them to provide you with feedback on the coupon, on the acceptability of the collateral, on the structure, and if they are saying that no, we are not interested, why they are not interested, what can we build into the structure to make them interested. That is where the credit enhancement aspect comes in, because that is an aspect you make after pre-marketing. So you are comfortable at the pre-marketing stage, you are comfortable that the product which you eventually will take to the market will have a higher degree of acceptance. I'm sure you'll all appreciate that in capital markets there are no guarantees. Yeah. The fundraising is always on a best effort basis unless and until you are willing to pay for the underwriting. Yeah. And the underwriting itself will probably cost you much more than the whole transaction cost itself. Yeah. So on those aspects, basically the pre-marketing is an essential tool, and we advise all our clients, we do the pre-marketing for all our engagements. We advise everyone to consider pre-marketing before they formally launch their product into the market. Yeah. Now, phase 3, the sales and distribution. So we have done phase 1. We have taken a jurisdiction, tax, regulatory, we have developed the structure, we have the Sharia scholars. Yeah. Basically we have the legal advisors, we have the documentation and everything, and we are in the sales side. Now on the sales side, the important aspect is to identify who do you want to partner with. The partner needs to have a decent track record in your target jurisdiction. Because currently the financial markets are flooded with consultants, unfortunately, who are claiming to be very successful in doing the things which they are claiming. I won't go into detail. It is basically more a judgmental call, looking at the track record, what they have done, how long they have been in the market, what they have done previously. Based on that, the sales partner needs to be identified. Now, the second point, the understanding of the Sharia aspects by the sales team. Now, this is something which has given, I would say, Khalij Islamic the greatest grief over the last 3 years. What I mean by that is, there have been certain products which we have been part of. We have been their advisors on the structuring side. We have provided them on the fatwa. We liaised with the legal advisors and provided them with a complete product. But they appointed someone else to do the sales, or they had their in-house sales team. Most of the conventional financial institutions have their in-house sales team. And when they started going to Islamic investors, yeah, they flopped. Because sale of an Islamic product and sale of a conventional product is a very different approach. The conventional sales guy only needs the term sheet. Only needs the term sheet. So he is going with a term sheet. He is selling the return. He is selling the credit risk. Yeah, and he is basically selling the maturity. These are the 3 aspects basically he's selling. But when you go and meet the Islamic investor, and assuming you are only equipped with the term sheet, yeah, the first question they will ask is, who are the scholars approved the structure? Now, if you don't know that, then the second question is going to be, what is the structure? Now, these are the 2 questions which a conventional sales team have never been exposed to. So if you fail in providing appropriate answers to the first two questions, you will not have any sale there. So what we advise our clients is that either you have a partner who understands Islamic finance, who can explain Islamic things, the structure and how basically the coupon is being generated and all, else take a member of our team during the roadshow. So we go there and we take care of all the Sharia questions. Because of this aspect, I have seen some very good products being failed because you never reached discussion to that level where you're talking about the return or the underlying asset or the maturity. Yeah. And the last thing which is important is the ongoing comfort over Sharia compliance. When you give a fatwa to investor, the investor says, okay, this is the structure, these are the legal documents, and this has been approved by the scholars. So the scholars are saying, if you do it this way, as per the structure, and you use this complete set of legal documents, your structure is Sharia compliant. But are you doing that? So for that purposes, Sharia advisor needs to come in, and depending upon the product, it has to do an Sharia monitoring. Its working papers are presented to the Sharia scholars. The Sharia scholars review it, and they sign an opinion on Sharia compliance, basically for that period. And that certificate goes to the investors, and investors remain comfortable that the transaction remains Sharia compliant. Yeah. So this was basically a quick, snapshot of the key considerations for new entrants into Islamic finance, and also we had a quick look at how investors basically look at the transaction. Now, I believe I've got a couple of minutes. Yeah. Okay. Now, I'll just talk about basically an important aspect as well. When we are going for an Islamic transaction, things have changed drastically over the last 4 or 5 years. Yeah. I have been doing basically roadshows. For example, I have done it with family offices back in 2006, 2007, and during the recession crisis and after the crisis. Yeah. The roadshows have been very different. When you used to go in 2006, yeah, we go to a family office, ultra high net worth. We would probably very good tea, yeah, nice. And the sheikh used to come, and in probably 10 minutes or 15 minutes, which most of them which will be talking about good things in life, we would get a commitment. Yeah, and in some places also a check. Then after the crisis, things changed significantly. Because of the lack of liquidity, it's not only the liquidity they had, they didn't lose liquidity per se, but the value of their assets significantly reduced because they were heavily invested in real estate. So theoretically, they were not as liquid as they thought they were. So we could clearly see that the quality of food has sort of gone down a bit. Some places it was only tea, yeah, and water we had to request for. The sheikh never used to turn up. Okay, it was either his CIO who would basically get the presentation and all, and they always used to say, we will get back to you. If you are really, really lucky and the sheikh turns up, his questions were more, or actually always in that case, was in the case of default. His questions were, okay, if things goes wrong, what is my security? What is the collateral? When I am going to get my money? How long will it take for me to get access to that asset in that jurisdiction. So the fundraising in the Middle East have become much more challenging. They have become much more aware. Earlier, in early 2000s, people used to consider Middle East as easy money. That is no longer the case. The money is there, but they have now well-educated, Western-educated people sitting on their side, and their analysis and assessment for any particular transaction is exactly the same how you would expect a European or an American financial institution will do. Yeah? The only difference is they have got a lot of money to invest. I'm not sure about the European or the American institutions. Yeah. So with this, basically, I end my presentation. I hope basically you would have, I would have been successfully able to share my experiences. If you've got any questions, I'd be happy to.